Good morning, it's Jeffrey Cohen, May 25th. Hopefully you're doing well. This is the pre-market action on the stock market. I got a whole bunch of things to tell you. And so I'm going to start off just by giving you the kind of the play-by-play yesterday and where we're looking for the markets today. Treasury yields are down on a short side. So if you're buying 1 month treasuries, it really means you're parking your money. You're getting 0.55% yield. It's still more than it was before, but it's a lot lower. 30-year money is still trading under 3%. So your long bonds are not yielding very much. The prices really haven't come down very much. And the 10-year money at 2.76, it's up. It used to be like 1%, 1.5%, but it's not that far up. So there is a little bit of a flight to fixed income here. But where we really see it is in investment grade debt. Bonds, okay? People bought a lot of investment grade bonds. So 5,873 issues were up yesterday and under 1,000 were down. That's about 6-1. I haven't seen numbers like that in quite a while. The highs to lows, you're looking at like it's under 5-1, 4-1 on lows to highs. So the bond market looked great. Now, it's not all that way because in the high yield, it's up like 1 1/3 to 1. And the new lows, look at that, 18 new highs on the high yield, 357 new lows. So the way you read that, the way you understand that is if it's General Electric, if it's IBM, if it's Exxon, people are buying their bonds, they're taking the yield. If it's Party City and Vroom and Snapchat and Auto Bytel or Auto Web, if it's really risky stuff, if Corbis had a bond, it'd be high yield. SMLP has bonds, right? So what this is saying is you have 357 new lows, which means higher and higher yields than ever before in the past year. 357 of them and 18 new highs. So junk is getting worse. That's what it means. Now on convertibles, because they have an equity kick, 0 new highs, 48 new lows. 54 advancers, 180 decliners. So I like to look at the bond market because it's a little bit more simple. And you see here that it's actually not that hard to understand. Fear of missing out is still a low-cost, high-safety strategy. There's still a lot of lows, right? But investment-grade bonds look great yesterday. In fact, I would say the same thing. US Treasuries looked great yesterday. Money is flowing into Treasuries, flowing into debt. By the way, there's nothing wrong with that, right? If you've got money and you don't want to put it in the stock market, it's okay to put it in bonds. It is. So now let's take a look at the futures. Let's see if we're alone in noticing this. So you notice the Dow is red, the S&P's red, the Nasdaq's red, the Russell's red. Now you know it could be a head fake. These are only down less than 0.5%. Nikkei was down yesterday. I know for a fact that China was up yesterday. China and Hong Kong are both up. Australia's up. What's interesting is some of the European markets, the specific ones, are actually up. The FTSE's up, Germany's up, the CAC, France is up, Euronext is up, so UK's up. So really the US is launching into a down morning, but the rest of the world, South Korea's up. Market looks pretty good. So for some reason though, US markets are down. So let's take a look. Maybe there's some news. So what we see out of Cohen, gas prices are up. Got it, right? There's no new news there. Oil prices are up. There's no news, right? There's no news in Cohen. You know, one thing that's always interesting is yesterday, the markets came down, and just a reminder, When the markets go down, growth goes down more than value. So value is a place to hide when stocks are going down. Growth is a place to make a ton of money when stocks are going up. So we ran our model yesterday, and it, by the way, we broke our report writing, so that's not nice, but we'll fix it. So there's not a lot of stocks in our up pick, and it's giving you basically 5.2 edge on the market. Dillard's, Max Linear, NVIDIA, Silvergate, SI Time, and the trading desk. Now, the trading desk fell off a bridge yesterday. I think it was down 20%. Model still likes it, right? These are high beta growth type of picks. And so when I looked, most of those are down today. So the indices are down. The efficient portfolio is down. So Jeff, what's going on? Why is everything down? Right? I don't know. It just is what it is, right? It's kind of a red morning. Now the VIX. I want to explain something about the VIX. So I want to thank some of the guys on Twitter yesterday for explaining this to me because honestly, I didn't really understand how to read the VIX. It's actually really funny. Like I talked about it, but it doesn't mean I really understood it. So now I understand it better. So I pulled out my handy calculator. So the VIX, the volatility index, historically, where are we at? Historically, the thing trades down by like 15. 15, and then it would peak at times, right? So let's take a look. What does Jeffrey? What does a volatility index of 15 mean in terms of daily price changes? So 15 divided by 19.1. The VIX was intended to trade every day. So you divide it by 19.1 to come up with a daily volatility. And that says 0.785. So when the market was rising slowly, and I should show you what that looks like, a market rising slowly. This is a market rising slowly. Very small moves. Not a lot of, if it was a sawtooth, they're very small sawteeth, right? When that happens, the VIX was trading at 0.78. So that means within two standard deviations, or 0.68, or 68% of the days, the S&P 500 is not going to move outside of a boundary of about 0.8%. It's 0.78. And you look, and you may buy the insurance to protect widows and orphans, but in general, when the market's going up, insurance gets pretty cheap because no one's really worried about a crash. Or, oh, look, it went up for like a whole year, right? So 0.78. So people, the cost of insurance, you made money if the market moved more than like 0.75%, 2/3 of the time. All right. So now we're at 30. So 30 divided by 19.1 is 1.57. So I'm going to show you what that looks like graphically, right? Because this helps. When you understand the VIX a little better, it really helps to make it make sense. So this is the S&P 500. I mean, they're the futures, but it's fine. Remember that number, 1.57, okay? So this says, and I want a daily chart, not a weekly. I want a daily chart. In a given day, it went from 40.84 to 39 something. That's like a 2 to 3% move. This one, 42.95, 40. Oh Jesus! No, that's crazy talk. That's like whole percents. Right? That's like multiple percents. So what happens is the market has been moving really high. So to buy insurance today, you're willing to pay to protect against market moves where you like break even. If 2/3 or 68% of the time, the market's going to move more than 1.57%. So that means you're thinking the market could drop 2, 3, 4% because you want to make a profit on your VIX investment. You don't want to lose money. So when a VIX is 30, you're betting that the market might move 1.5% 2/3 of the time, or less than 2/3. 2/3 of the time it moves 1.5% or less. So that's the insurance. And so you're really worried. You're really worried when it pops up. So let's say that were to hit 40, which is a crazy number for the VIX. I mean, you know what it's going to be. Divide it by 19.1, right? So that says 2.1% moves roughly 1/3 of the time. That's a crazy rocketing up and down, right? And so the VIX is what you pay to protect yourself against those big moves, and it's all probabilistic. So I just want to share that with you because that's like a big deal. So a VIX of 30 means you're protecting yourself against 1.5% or more moves every day, right? Within 2/3 of the time. So what do we talk about? Bonds look good. Money's flowing into bonds. The futures are red. The VIX is up. How's the dollar? Thank God the dollar is at $1.658 for the euro. A euro is $1.658. That thing was over $1.07 yesterday. That's crazy talk for the U.S. dollar. That means the dollar's weak. So we're all in Davos. Everyone's chit-chatting, talking down the dollar. So, because right now the dollar's actually weak. A weak dollar is actually good for the stock market. A stronger, strengthening dollar is bad for the stock market because companies that sell globally, General Electric, Honeywell, IBM, Lockheed Martin, Boeing, all those guys, when they bring back their profits and the dollar is strong, it means that there's fewer dollars. So a weak dollar makes it cheaper to sell American goods overseas, and it just helps us. So where are we at with metals? I do like to follow the metals. So silver is down 1%. Silver does have a slight positive beta with the market. Gold has a negative beta with the market. So gold is down. That's not a real player. That's like the tip of the tail. But silver down is not good for the market. In my opinion, Jeffrey Cohen, investment advisor representative for US Advanced Computing Infrastructures, Inc. We are also a federal contractor. We do data analytics to help people make decisions. We're really good at that. We have our own models, proprietary models running on a server. Copper's down, but not much, 1%. Oil's up. So second, third order effects in this market I think are important to understand. I got a whole bunch of things to show you, but I think this is probably the most important thing for you to take away this morning. Unless you're like an insider in the market, right? If you're at Goldman Sachs right now or Morgan Stanley, you probably already know this. But if you're like some regular person like I am, you may not. So when the price of oil goes up and stays up, wow, must be great because the economy is so strong that we're going to use more oil. Well, that's one way to look at it. The second way to look at it is gasoline is at $3.87 a gallon wholesale. $3.87.67, so $3.88 a gallon wholesale. It's up 6.5 cents today. Imagine if everyone went to the gas station today and paid 6.5 cents more for gas. But it's more than that because there's a markup, there's taxes, there's all that. So let's say they paid 10 cents more a gallon today. One of those people's probably going to quit their job. And one of those people might not drive their car tomorrow. They might not go to the grocery store. They might just eat the food they have. They won't go to the restaurant. They definitely won't go to buy clothes, and they're not going to Walmart or Target to buy a bunch of crap that they don't need. A backpack. Sheets for their beds. No, they're going to wait. 10 cents a gallon. Do you know that my wife told me yesterday, just out of the blue, we have the cheapest cars. We have like a Toyota, fuel-efficient Toyota, like tiny car. The thing gets great gas mileage. She's like, Jeff, I just spent $48 to fill up the car. She may not want to go to work today. Now, she went to work, but maybe not to $48 to fill up the car. It's a small gas tank, right? So my point is, when you see oil and gas go up and stay up, gasoline prices have been over $3 a gallon wholesale since March. So that's almost 3 months. That's 2 months, 2 to 3 months. After a while, it's too much already. And so I believe gasoline causes recessions. When gas prices go up, it stops activity. I believe it with my heart. And I think crude oil is a secondary condition because oil goes into the refinery, and normally the refineries act as a buffer between oil prices, crude oil prices, and gasoline. Because you refine a bunch of gas and you stick it in tanks and you sell out the tanks. And so if oil goes up a day, 2 days, it's fine because the gas was already made that we're putting in our tanks. But the hedges are running out. That's the thing. Commercial hedgers are down. They can't afford to hedge at these prices. So they're like, you know what? I'm going to pump oil out of the ground. I'm just going to sell it at the spot price because it's great. They were hedging at 70, probably thinking they were making a mint at 80, at 60, at 70. So normally you would hedge forward to protect yourself against the market falling. My guess is selling hedges now at $110 a barrel is cost prohibitive, and therefore you're just going to sell it at the spot. So now a move in the price of crude affects the price of gasoline that much more. So I think this is terrible for the market. I think if anyone who handles industrial policy is listening, please figure out how to fix gasoline prices, which means fixing crude oil prices, which is a global commodity. We can't just fix it in the U.S. And that's real work. So I think that's about all I want to talk about. The last thing I want to show you is when I start looking at bankruptcy websites, you start worrying. I'm going to get into the chat. Just say AMA. Ask me anything. Bankruptcy data. Take a trial. The database of record for corporate bankruptcy and restructuring. So I'm going to show you some things, and it's going to maybe scare you a little bit, but I think now's the time to start watching. Right when COVID hit, this was one of my favorite websites. I actually signed up for a free trial. I got all this bankruptcy info. I was looking at restructuring data because, to be honest, when the market falls, when people can't afford to buy the gasoline for their cars, well, everything comes down. We're going to see empty stores. Now, in our neighborhood, I live in the North Shore of Chicago. It's a beautiful neighborhood. It reminds me of Greenwich, Connecticut. It's beautiful. It's expensive. It's safe, right? It's great. Love it. We still have a Toys R Us shuttered. We probably have a third of our retail shuttered. Do you know in the Northbrook Mall, they took a wrecking ball and they tore down about a quarter of the mall because they couldn't afford to pay the property tax on the empty stores. Vernon Hills malls, I saw them take a wrecking ball and take out the old Sears. That's what's happening, right? So we're going to start to see some bankruptcy and we're going to start to make bank, right? Because that's how we roll. So let's take a look. So I just want to share that with you because when I start looking at bankruptcy, it's still a little early for bankruptcies. But I'm not sure how much early it is. So let's take a look at stocks. So these are, and I got a spreadsheet I can show you, but it's more interesting to look at it this way. These are stocks yesterday that are down in price with strong fundamentals. First thing you notice is most of them are red. Now, auto does not have strong fundamentals. That's kind of an anomaly in this list. Just because I want to look at it. It's down. It's got crappy fundamentals. But it's down 12.5%. But you take a look at all the red, very little green. These are stocks that had, and then Rewalk is also different. Rewalk I'm looking at because it's just a God and country kind of stuff. It's good for people. It helps people. So it's mostly red yesterday. So stocks that had strong fundamentals were down. Now, what's interesting is these are the stocks that we call that are going to drop when the market goes down, it's going to drop. And so you look at how red these are. So if you would have bought our run yesterday, by the way, we eliminated our discounts, but you could have bought the run for $200. You could have gotten a whole list of these stocks. Current, this was like a week old. And every one of them, except for one, dropped. Actually, PDS comes from a friend of ours. That's actually not one of our down stocks. So every one of them would have fallen. So you would have said, Jeff, sell me the down run. You would have shorted 5 of them. You would have made a mint. Hopefully you would have made more than the $200 you paid, right? Let's take a look at the up stocks. Now, this was the larger portfolio. The market took a dump. Look at that, how red that is. And I'm sorry if you bought the up run and you invested in these, you lost money, but the S&P 500 was down. Let's take a look at how they are pre-market, because this is a pre-market call. And they're down again today. So what this tells me is the futures may not be down by much, but people are not only down the futures, equity futures, they're also down those stocks. And I bet you, if we look at the down stocks and we look at pre-market, okay, this is interesting. They're not all down. So what this tells me is there's people that are betting that the market's going to go up today. They are pumping money into the high-risk meme stocks. Wow, is that interesting? So that's a little bit of a mixed message. Let's see if there's other mixed messages out there. Money managers, right? Of course, you want to be short the money managers if the market's going to crash. Money managers have assets on their books and they have to mark to market. They also have to make up for customer risk, customer credit risk, customer portfolio risk, which turns into credit risk. Plus, a lot of these guys have a lot of debt, and as the debt gets more expensive, if they're not generating cash from their business, they can't really pay it off. But if you look, there's 4 money managers up. By the way, Franklin Resources, love those guys. They're a heavy fixed income shop. They're up. Fixed income's looking good. Not a lot of high percentages down. So, although the VIX is up, no one's really betting on a crash today. Chips and dips, all red. Okay, this is bad for the market today. So, semiconductors, NVIDIA, Qualcomm, Broadcom, although Broadcom could also be because of the VMware acquisition that they announced, but maybe not. So all your chips and dips are down today, chips and semiconductors. How's cannabis? There's a real risky one. It's a bit down, right? The picks and shovels are down. But some of it's up. That's very interesting. Oh, and your tobacco's up. So people, maybe they're rushing to those dividend stocks. So, it's an interesting market. And then I got stocks. I'm sorry. I'm going to change the name to stonks. Because that's a bad word. Nobody wants that. Let's fix that. There could be kids watching. Stonks. These are stocks that are down. How are they looking pre-market? So, when we see stocks like Bird Global down, this is one of those that's going to show up in the bankruptcy chart. Woo-woo. They sell like little scooters and bicycles and stuff to help the environment, but they don't really make any money. BBIG is a meme stock. Any of these up? Bear AI. So that one's interesting. So we've talked a lot about that one. So that one looks like it's tending to go up. People look like they're going to catch the falling knife with Tupperware. They're going to catch the falling knife with SelectQuote and Regis. Be careful out there. Backed Holdings, ATI Physical Therapy, they're going to catch that falling knife. Lightwave Logic. Now, Party City, maybe people realize. So what's going to happen is these stocks, people are going to look at it and say, you know what, maybe I don't want to catch the falling knife. And so let's look pre-market again. So Big Bear AI is down because it's a meme stock, right? Structurally, they're not a real economic profit kind of a company. They're a government contractor. I want to say 2/3 of all the employees have top secret clearance, and they work in secret clearance locations. This is not a .com stock. This is a solid government contracting stock. Tupperware, self-inflicted wound. Select Quote, drop in revenue. Regis Corp, tremendous drop in revenue. Rewalk Robotics is just it's like a biotech bet. I love their business. Avaya, so these are and Avaya just had a terrible quarter, right? So these are catch a falling knife bets this morning. AutoWeb, Vroom, AMC, Rite Aid, Tellurian, oh my God, Kyndryl. So it's just interesting, right? So if you're out there, just please be careful. I get it. You want to get in before the stocks go back up again, but do I have to? I'm going to do it. I'm going to go back to the bond info, right? Because this is where the rubber really meets the road. New highs to new lows. 81 highs, 694 lows. There's still more lows than highs. Things are still going down faster than they're going up. And I don't have the number here, new lows, new highs. My guess is, from a stock perspective, it's still pretty dramatic. And so just be careful if you're going to catch a falling knife. I would suggest sit on your hands for a few more weeks. Just wait it out, wait it out, wait it out. It's going to be okay. You don't have to be the first one back in. All right, last but not least, let's take a look. Where are we at? So the SQQQ still at 60. TNA at 37. The Spiders at 392. The QQQ's at 285 and the IWM at 175. What's interesting here is not long ago that was 178. It was 172. You're kind of in the middle. The QQQ under 300 is actually fine. It's 285. It's not a big drop. The Spider under 400, a little bit of a risk, but not that bad. Markets aren't really moving that much. So, last thing to show you. If you're looking to buy individual stocks and you're looking for a good screener, we give this spreadsheet to all of our clients. If you buy a run, you get the spreadsheet. It's green because it's the up run, profitable companies with positive cash flow. And so what we did is we highlight companies that have total market capitalization, which is debt plus equity, divided by cash flow from operations, divided by net income, with a multiple of less than a certain number. Number one stock in our model. ATLO, Ames National. Okay, what the hell's that? I never even heard of them. And you got a few more over here. Point is, you're going to find stocks that are trading historically that trade very well. And this is the first of many bank holding companies, small bank holding companies. Many of them don't even issue 10Qs that are in our model trading it at very pleasant multiples. We're going to start looking at book value per share. We're going to start looking at loan portfolios. And some of these, especially as the market drops, if bank holding companies drop, they are a source of tremendous value in this market. And then Artisan Partners, they pay a nice dividend. We've looked at them before. So this is the type of thing that you can do. Look for companies with strong cash flow, strong book value, where you think that stock is going to continue to go up and continue to perform even in this down market. Fidelity National Financial. They, if I remember right, FNF, they provide information to banks and bank holding companies and traders. That's a good market. That's not going to be affected much by gasoline prices. And you're stealing it at 4 times cash. So that's how you're going to find stocks to invest in. You start with this list. It's not a done deal. Then you do your due diligence and you rock and roll. By the way, market opens in 3 minutes. If you enjoyed the video, please do me a favor. Drop a comment below. Hey, Jeff, love the video. Hey, got some questions. What do you mean FNF is at 4 times cash? Can't be. What's going on here? Right? It's an $11.5 billion market cap. There's no way they generated all that cash. They did. But leave a comment. I'll answer it. I'll do some homework. And then there's a red subscribe button. Please hit the subscribe button. We are not paid to make these videos. I get my daughter on the bus. I send my wife to work. I come here and I do all this homework for you to make me better and to make you better trading. So hit the subscribe button. It really helps. And, maybe share the link. Let people know that you watch it, that you like it. I'd love to get more viewers. It really helps me. It makes me feel better. So, hey, thanks very much. Good luck in the market today. Hope you make a ton of money. Bye-bye now.